Alrighty, folks, you are in for a treat. We have the one and only and lovely Melody Wright with us. Melody Wright has been on the channel a couple of times. She and I don't always agree, which makes it for a very, very fun conversation. Melody, how you doing?
I'm doing well. Thank you so much. And thank you, of course, for having me back.
Oh, I love you being on the channel. Love you helping me get smarter. Because again, you have experience in an area where I have very, very little. So let's just remind folks if they don't know who Melody Wright is, talk about your history, your track record, a little bit about resume, and then we'll get into the fun part of the conversation.
Sure. And so I'll go really quickly, but I fell into mortgage in 2006 by complete accident, which is how everyone gets into mortgage. And it was at a very turbulent time. It was right at the top of the previous cycle. And we'd been purchased by a private equity group, Cerberus Capital. And so, as good little PE guys, they wanted to make sure that they had paid a fair price as they saw certain housing metrics kind of turning around. And so I really helped kind of gather all of the management reporting from across the company to kind of show them what was happening. And quickly we realized, well, Cerberus realized it wanted a purchase price adjustment. And so,
We're not paying that.
exactly. So things just went crazy from there, and we kind of led the write downs because of that. And so we were out early before Chase and Bank of America and others. But it was a really crazy time that people say, the GFC 2008. Well, if you were in mortgage, it lasted a whole lot longer than that. And, my company held on from all that time in 2006 until we filed bankruptcy, basically in 2012. And so
Mm,
it was a long road. So I started in corporate finance, kind of looking at both origination and servicing and what's supposed to be a natural hedge that doesn't always work out, especially when people get a little addicted to what we call that gain on sale when you deliver those loans to the GSEs, being Fannie Freddie, or to Ginnie Mae, FHA, VA. And so, anyway, I got a crash course in all things mortgage. And really kind of was at the forefront helping to write messaging for investor presentations and things of that nature. And then went on to help manage our bankruptcy as well as a consent order and the AG settlement. And then ultimately, my president asked me to help them get through the default crisis because we were getting pressure from Fannie and Freddie to clear our seriously delinquent loans. So,
mm,
yes, guys, you heard it here. The government was pushing us to move these loans along. And so it was kind of my job to figure out what did successful exit look like for some
mm,
of these borrowers, the ones that were still there. Many walked away, as we know. So did that, kind of left after the bankruptcy, went off to other non-bank originators and servicers and realized, no one was changing the technology. Nothing had changed. And if I wanted change, I was going to have to do it. So I went off to fintech companies where I built technology or wraparound solutions for many years. And at the same time, I started diving into macro, kind of looking at what else, how did all those people get it so wrong last time? All these economists that kept telling us the housing market was turning around. We saw home prices go up and down until they didn't do that anymore,
mm.
until they just had one trajectory. But I really needed to understand because one of my bosses is like, please tell me when rates are going to rise because we don't want to be caught out, right? Well, I told them, they just didn't believe me, and they were also caught out again as
Oh,
things started to slow down. So that's been the really interesting thing. But anyway, I dove in, I was reading the narratives. I was like, this doesn't make any sense. I didn't feel like anybody had the whole story. I felt like I was looking at it from a much like
mm,
wider lens. And so I went out on the road and visited some of these, really kind of over speculated towns. I've come like Nashville, Charlotte, Austin, et cetera, to really get a sense of what was true inventory out there. Cause I just did not understand the inventory shortage. It did not make any sense to me understanding what I knew about demographics. So that's a really long story. I wrote an article last January called Debunking the Inventory Myth for Housing Wire, and it lists a lot of my themes in there. You guys can go check it out. But that's how I arrived here today. And I also track 75 local markets each week in my Substack. So
yeah. And
that
let's
was a
call out
lot.
your Substack. No, that was great. Where is your Substack if somebody wanted to check out your writings, which I have? You're an excellent writer, very data oriented, which I appreciate. What is the Substack so people go look it up?
It's just called M3 Melody Substack. So you can Google that, it'll take you right there.
Yeah, folks, if you're not going there, I suggest going there. Even if you may not agree with the
That's right.
opinions, I think understanding the data and what she's looking at is important. For example, one of our very first conversations, you highlighted that you were really keen on, at that time, I think it was the 60-day delinquency.
Yeah.
Then the next time we spoke, it moved to the 30-day delinquency was seeing some upticks. Where are we now at closing out of 2023?
So we're still saying pretty muted, what I call seriously delinquent loans. But we're actually continuing to see increases in 30 and 60-day delinquencies as the consumer comes under stress, due to property taxes and raising insurance bills. And that all kind of always hits for our big states like California and Florida at the end of the year, and then kind of in the spring we get Texas. And so
Mm.
as part of my job, I still have clients where I actually listen to borrower calls, believe it or not. They tape them, I
Whoa.
listen to them. Yeah.
Yeah.
Yeah. And I mean, taxes have just hit borrowers like a ton of bricks. And of course, there's going to be workout solutions, but what I don't think people understand is the ones that we have are very limited, even if you put it out there for 40 years,
Mm.
especially on the rates. They could end up actually having to pay more, some of these programs. And so the government's trying to retool them. And I think it's Michael, it's not a huge part of my thesis, the
Mhm.
delinquency. It's a component,
Right.
but it's definitely ticking up, and the seriously delinquent should be at 0, to be honest with you, with all the programs that we've had. And the fact that, the CFPB says you cannot send the loan to foreclosure until it's 120 days delinquent. And then you tack on top of that the fact they just put the VA foreclosure moratorium on. And so, this stuff's going to go really slowly, but consumers are definitely coming under stress.
Yeah. I don't know the recent numbers on 30-day or 60-day. They're certainly up. Totally get it. But are they back to historical trends or not yet?
So FHA and VA are,
Okay.
and so, yeah, and then, but Fannie and Freddie, not so much, but you have to kind of, it depends on what you're looking at. Are you looking at what's in the MBS?
Mm.
Fannie, Freddie, they do these credit risk transfers,
Yep.
you know, uh, they also do the FHA does these single family loan sales to get all of those crappy loans off their books and into the
Right.
hands typically of nonprofits. Anyway, but so you always have to be cautious about, like, Mortgage Monitor came out and said, okay, yeah, they saw tick up in delinquency in my private books. Everything kind of stayed the same, but you could
Mm.
see that kind of roll the 30 was increasing, or the people that were
Okay.
getting really, really, really close to rolling. And so as we go through this time period, I think we're going to have some push and pull on the numbers, but
Okay.
they're not trending in the right direction. And FHA, VA are very concerning and at pre-pandemic highs. I mean, FHA is just at 9% overall delinquency. That is just massive.
Wow. So
Mhm.
9% overall delinquency is 30, 60, 90. It's all buckets,
The
right?
whole span, correct.
Oh,
Yeah.
so that's 1 in 10 FHA borrowers. If
Yeah.
I'm doing the math right, roughly. That's
Right. And
probably
just
not good.
I just think that's after a payment defer, like, or well, they call it the
Mm.
partial claim in FHA land, but that's where they took, those 18 months of forborn parent payments and put them at the back of the loan. So
Oh,
not
wow.
only did they not have to pay, then they also just put it on the back of the loan to be paid off at when they close or I'm sorry, when they sell the house or pay it off. And then you also have these additional 40-year modification. And so all of that, Michael, and the kitchen sink is being thrown at them. And we
Right.
still have over 9%. And actually, it's more, it's like 9.4%,
Yeah, let's just
9.5.
call it 1 in 10. Let's just call it 1 in
Exactly.
10. Yeah, let's just round up just a little
Yeah,
bit. Yeah,
exactly.
I
So there
had
you go.
again, 1 in 10, 30, 60, 90 are serious. Those are the buckets, right? The 4
Yeah.
buckets. Wow, I had no idea. All right. That's not good. And what was it like 2018, 19, like 6, 7%?
So yeah, sorry, I hate talking numbers when I don't have it right in front of me, but the key on the FHA is that we've more than doubled FHA
Mm.
lending since 2009. And so in many ways, it is subprime. You'll look at the credit scores.
Yep.
I'm not making this up, 580, 620, depending on your
Yeah.
down payment. And what is concerning me, Michael, is I'm seeing one of my jobs in the heyday was to look at credit quality, look at,
Mhm.
what does my loan to value look like? What are my credit scores? Where are they trending? I'm seeing credit scores I did not see this low back in the crisis. Like, and they're not even in foreclosure yet. They're not even in foreclosure. And so anyway, I don't have the exact numbers, but I'm with you
Okay.
that that 6%
Yeah.
overall kind of sounded like when things really, like, everybody could hear the wheels starting to come off the bus. And
Right.
so for FHA to already, we've doubled that lending, and
Yeah.
for it to already be at 9%, it's just problematic.
Yeah. It's probably not good. It's probably not good. Um, well, you know what? Something I would love to do with you, we're sitting here, well, let's just call it the end of 2023. We all had thoughts and opinions on what 2023 would turn out to be. When you look back, what was something that maybe surprised you either way, negative, positive, something that surprised you? And then more importantly, we'll talk about 2024 next, but anything particularly surprised you about 2023?
I would say not the results, but just how long the
Mm.
builders were able to keep going. And I just, we had this. So I after what I saw on the road, and I saw these massive subdivisions with, Lennar flags flying over, and there's
Yeah.
nobody there. It's like it's like a Wild West, where the
Yeah.
tumbleweeds are like,
Yep.
that's what it was like everywhere. And I just was like, okay, like, and I looked at
Mm.
the builder balance sheets, and I was like, there's no way they're gonna keep this going.
Okay.
Well, they got really crafty about those buy downs, those
Yeah.
incentives, and they affected that 15 to 25% net price reduction. Now, I knew there would be demand. A lot of people didn't think we'd have anything. Like, they thought 2023 was just going to be, terrible.
Yeah.
But the builders really kept it going. They're at about 30% of what's being sold out there right now, which is above their historical average.
Yeah.
And so I think the fact that we were able to really ride this wave of narrative, when you're seeing existing home sales just like go into the,
Freighter.
right, just, I mean, it's just ugly. And so, but everybody still seems to think everything's okay. I mean, that's I think what's kind of that we were able to ride this
Mm.
narrative for so long, as what I think is shocking. But you're seeing here at the end of year, inventory is ticking up,
Yep.
new home sales are down, pending sales today, which is, in my opinion, one of the worst metrics, but still it's at the
Yeah.
lowest level since 2001, and the
Yeah.
lowest on record for the Sun Belt market, for the South.
Yeah.
I mean, this is some crazy stuff. And so it seems to all be piling up here at the end of the year, and we were able to
Mm.
kind of skate on this Fed debate, and on this,
Yeah.
will he not pivot, and
Yeah.
just all of this narrative. And so I think
Yeah.
that was the most shocking thing of all to me.
I wanted to ask you about existing home sales because you're right. I actually called 3.8 million would be the bottom. We hit 379. I think it was October's annualized number. Um,
Nice.
but there was a lot of folks I'll call them crash bros just as a just they're not even in housing for the most part, but whatever.
Right.
They talk housing all the time. They seem to have been pushing a thesis that transactions crashing 40% meant median price would have to come down, and it didn't.
Right.
Do you do you see that as a surprise? You're in housing, so you may not have seen it that way. But man, there was a lot of people screaming, prices got to fall, transactions falling. And I'm like, that's not how it works. But I'm just curious.
Now when everybody's on strike and they think they're right, right?
Yeah.
Like, the buyers think they're right, the sellers think they're right.
Yeah.
And those new home sales just came in to, like,
Yeah.
they just they picked up the demand that would have
Hmm.
forced the existing to kind of, really meet that
Yeah.
buyer. And so I think it just kind of kept it frozen in, and I'll say absolutely, I did not say that home prices would crash, but I did say don't be surprised if in certain markets they
Yeah.
come down as fast as they go up. And I'll say that for next year as well. That's
Yeah.
not my thesis overall. I see probably around a 5% reduction next year, and then 2025 to be the worst.
Oh, okay.
And then,
I like it.
yeah, and then kind of out from there. But,
Got it.
I think that we've got an election year on our hands. We got
Yeah.
a lot of people that are gonna, the two words affordable housing, we might as well, you and I should probably do a bet of how many times it gets mentioned, like, we'll do a count.
It's gonna
And
be a lot.
it's gonna be, I think it's gonna be the top one of the top three issues that people campaign on.
I
And
agree
so
with you.
then they're
Yes.
gonna throw out some crazy solutions that don't help anybody, and that's gonna keep everything. We still have 5 billion in homeowner assistance funds out there from last year
5 billion.
that has not been used. Like some
Yeah,
of your states like Florida are close to using it all, but most states are not.
that's
And they've
amazing.
got another $10 billion budget that they want to
Mm.
pass for 2024. And we
Yeah,
still have 5 billion. Yeah. So
the
anyway.
the big thing for me, you're right. I think affordable housing is going to be like plastered on all the politicians. But the problem, at least where I sit, is my words, not yours. Feel free to disagree. Is it's all freaking demand oriented.
Mhm.
We don't need more demand. We would like
Right.
some more supply, please. Um, yeah, that's what I think.
Well, I think we're getting it. And this is
Great.
so here in Florida. So, because I spent most of 2012 and 2013 in Florida in
Mm,
managing the default crisis, I went there again and spent a couple of months just, really driving around, looking around. And Fort Lauderdale is already in a lot of trouble. Southwest Florida is in a world of hurt.
mhm.
Miami is coming. I mean, Fort
Yeah.
Myers, like the inventory is just so, seasonally between November and December, we see about a 10% drop in inventory. Like that's just because nobody wants to sell their
Yeah,
house during Christmas and New Year's.
you're
Why
right.
would you want to do that? Well, in these Florida cities, that's not what's happening. And by
Mm,
the way, this is their selling season. So I'm not,
yeah.
but the pace or how much it's outpacing is very interesting. And then the price reductions, like, when you are tracking local markets, you can actually look deep and see what's
Yeah.
happening. And Florida is one of the largest housing market. It's always, usually it's California, Florida, New York and Texas that drive
Mhm.
the national narrative.
Correct.
And, we've had our issues in Texas already, and they're getting worse. It was surrounded by Austin, but now Dallas and Houston and San Antonio are joining the party. And then you've got, California was already a bloodbath. And then you've got, kind of Florida is starting to make its turn. And there are a couple of key cities in Tennessee that I think Tennessee this time around, because of all the speculation,
Mm,
Johnson City, where I am, was one of the top four, best places to move last year.
wow.
But we're starting to see those markets come under stress from inventory is growing, and not only listings for sale, but listings for rent, as well as they have elevated short-term
Mm,
rental listings. So,
yeah. Yeah, I think there are plenty of cities. I'm sure you saw this one that was like, no kidding, folks. There was this, I think it was on Twitter or X, Joshua Tree. I'm sure you saw the post where there was some house that sold for like 660, all tricked out Airbnb, just retraded 2 years later at like 380 or 360
oh
or something.
Lord.
I'm
Yeah,
like, yeah, it's not get rich quick, folks. It's not, it's a desert for a reason. I mean, yeah,
that's
it's
right.
yeah,
And
when
like you always say, you have to work at it. You
yeah,
can't, yeah.
yeah,
So,
you gotta do the work. You gotta have a
yeah.
buy box. You gotta get in the weeds. You gotta know your market.
Yes,
Um,
yes, yes.
it is the other thing that's when I say all of that, it is possible to find a great deal. I think there's a lot
Yeah.
of folks that's like, it can't be done. I'm like,
Oh,
it
yeah, it
can
can.
be. It can be. Yeah.
Absolutely.
Yeah.
Yeah, I
So
mean, have the right facts on your side and, go in there
yeah.
and, know if they're delinquent on their property taxes and,
Yeah.
if you know the system. And that's what
Yeah.
I say to people. It's like, everybody calls me a doomer or whatever. It's like, no, I'm just trying to educate you on how
Right.
it works. Because once you know how it works and
Yeah.
what's for you and what's against you, then you can of course be successful.
Yeah.
So,
And that's why that's why I invite you back as often as I do, because I don't see you as a doomer. I
yeah.
see you as somebody who educates folks on what's really happening. And oh, by the
Right.
way, on an important area that I have zero experience.
Right.
So that's why I keep reaching out to you saying, will you
Well,
please
thank
come
you.
back on and have a conversation with me? But
Yes.
yes, I've seen you be categorized as a doomer, which
Oh
I
yeah.
don't do, but
Crash
it happens.
sister.
Yeah, it happens. It happens.
Yep.
I actually want to go to 2024 and 2025 because you dropped a little thing there that I want to go
Yeah,
scratch. I want to be clear so I don't misquote you. Median home price 2024 nationwide down 5%, 2025 worse than 2024. Did I summarize that right?
that's correct. And I'm looking at about 12%, I would say in 2025.
Ooh,
And that's if everything just keeps going
yeah,
as
I
is.
understand.
Nothing changes. We don't have a credit crisis. Suddenly we don't have a big bank blow up and 30,000 people lose their jobs.
Right.
That
Yeah, yeah.
that's the kind of thing, but that's if we just keep going right
Okay.
now with nothing else changing.
So
Yeah.
based on that, am I right in interpreting you that you see risk to the downside, not to the upside?
That's right. Yep.
Okay. So five, -5 and -12 is kind of the best case scenario. It can get worse from there.
I think so, and I think
Okay.
in some cities, I mean, where when awareness happens in a place like Dallas, I think that could
Yeah.
happen really quickly, and this multifamily is a big component, that I think is just it's just exploding everywhere, and I think people had an idea that these numbers until they're, like, in development, they're not really there until they're in
Yeah.
your face, and I
Yeah.
think that it's in everybody it's getting to be in everybody's face right now. Yeah.
So let's push that a little bit because I'm not sure what you mean by so multifamily apartments, I'm guessing, not
Yeah.
fourplexes,
Yeah.
apartments. Okay.
Yeah.
And you're talking about new supplies where I think you're going with this.
Correct. Yeah.
Okay.
Mhm.
Yeah. So Sun Belt, a lot of new supply coming,
Yes.
which will be competition for existing, all of
Yes.
that. I'll say this, and I'll see if you agree or disagree. Um, I think the pain in commercial, so office, multifamily, I'm willing to bet it's 4 or 5x what happens in single family. So 4 or 500% worse than what happens in single family for a short term, like,
For a short
24,
term.
25,
Yeah.
26. Yeah, for a two,
Yeah.
3 year window. Does that
Yeah,
feel
and
okay?
and it could end up yeah, and it could end up net being much worse, but I see the 2 as inextricably linked, meaning a lot of these new single like what I saw in Round Rock, Texas, for instance, the nightmare that is there was all because of an Amazon facility that's not gonna be built, so all
Ah,
these and this is what I keep telling people, it's not just your national builders, your locals look at your nationals and they say, "Ooh, this is gonna be a great idea." They just
yeehaw!
come on over and it's a block down the road, and the national doesn't even know it's there because Ivy
Mm,
Zelman's not tracking it, Zonda's not tracking it because it's a
right.
local private
Yeah,
builder,
it's
and
small.
so
Yeah.
you just the amount of developments, but it was all around commercial, and so
Right.
I think that these 2 are very linked. We're gonna soon find out, like, for
Mm,
instance, in Las Vegas, where the whole Hugh Henry Center or not Hugh Henry, gosh, I'm gonna get it wrong, but anyway, this
yeah.
huge center there of, like, 12 Class A commercial,
Mhm,
it's going by the wayside. I mean, it's over there. There's nothing
mm.
left, and so they went out and built more in the exurbs, but you also have more inside. So somebody's gonna, be a big loser here, and I
Somebody's
think
taking a haircut.
exactly, exactly,
Yeah.
yep.
Yeah, it's really funny because again, a lot of those Class A things, it's owned by REITs, obviously, which will hurt stock
Mhm.
portfolios,
Yep.
insurance companies, which will hurt,
Yes.
rates. And there's a lot of the Class A stuff was always seen as like the gold standard.
Yep.
And
Yep,
yeah,
location matters. Yeah.
yeah, location matters. So it's really so let's talk about 2024 because
Yeah.
we certainly disagree about 24. I think the chances of it being up 5% or greater than and again, we're talking national, we're
Yeah.
not talking Austin or Miami or your
Aggregate,
city is your
correct.
city.
Yep. Mhm.
Um and I think most of that is because I see the chances of quote unquote a soft landing, meaning positive GDP growth all 4 quarters. I see interest rates kind of settling in the low sixes. I really hope we don't crash to the low fives because that would be bananas.
Mhm.
Um, but when I look at 2024, I would say unemployment stays below 4.3, rates are call it 6, and we have no recession. And in that case, I'm going to call national up 5%. Which of my 3 categories do I have wrong, you think?
Well, I so rates to me with everything that's going on globally right now, that's the biggest wild card. Like we don't,
Mm,
I mean, there's a lot of national actors that impact, that 10-year
mm,
treasury yield, which is what mortgage rates track. They don't
er,
what the Fed does on the short end, there it's a things are all tied together, but we
yes.
watch those 10-year rates and what's going on in Japan could have some impact, but there is something, and I really hate spending a lot of time talking about the Fed, but I will say that something was seen on the horizon, whatever
Mm,
that was, and I
I
think
agree. I agree.
if you follow Danielle DiMartino Booth,
I
she's
do.
called the recessions, and I know you do, and she's called the recession starting in October. And I got to be honest with you, every leading metric I look at, something happened in September. Like it was, I
Mm,
mean, like beginning of October, it was like, vroom, like just the
mm.
floor dropped out. So I think that likely they're if we're not winning already, like Danielle says, and I just predictions aren't my thing.
No, no, I
Um,
got it. Yeah, it's
yeah,
fine.
path is, but I do believe we're gonna have a recession. If we don't have it next year, it's coming soon on the heels because what's happening with property taxes and insurance means people aren't spending. And if you have,
Yeah.
a minute
Done
for a
good.
little
Yeah.
story, I have,
Yeah. Go ahead.
in my family, two doctors, top 20%. You know, I look at them a lot of times to see what's the behavior of the top
Yeah.
20%, right? And so last year, so I asked them first thing, okay, where are you guys going this year? Because they always do two big, huge, fun trips and little ones. And last year they did, almost 8 days in New York City at prime. It was very expensive. They did a 10 day Italian, France,
Mm.
Spain cruise. And then they weren't going to do anything, but their friends invited them to like Turks and Caicos and said, hey, we'll pay
Why
your,
not?
yeah, we're going to cook everything for you. All you have to pay is airfare. And they're like, okay. They thought, what a deal, right?
Mm.
Oh no. And so the answer was, we're not going anywhere next year.
Okay.
And it's time to start cutting down the Starbucks visits. It's
Mm.
time to start cutting down the Chick-fil-A visits.
Ah, okay.
And I think that so even your top 20% has come to a point where like, you know what? Like this just we can't keep doing this if we're not gonna, because they're not they have poor kids that'll be going to college, and
Yeah.
we've seen college costs just go through the roof. And so, to me, a lot of times it's individual stories, but they all kind of
Oh, yeah.
coincide together.
I
And
love
so
it.
I think that the top 20 might be ready to like pull back a little bit. And so with them pulling back, as well as those that decided, the 60% that decided to pay their student loans, not all of them, but I think you've got the K collapsing now. And
Mm.
so I think from the top and the bottom, you're going to see constricted spending. And
Hmm.
I think that that's going to speed up the
Uh,
recession. Yeah.
I love that logic. I love that story. I think the top 20%, the last time I saw it, makes up 43% of all discretionary spending.
Right.
So if they are pulling back even a little bit, that will absolutely hurt an economy that is consumer driven. So I think that's excellent logic. I'd be remiss if we didn't talk about 2025. You likely know this, but I'll share it with the audience. The worst year of the Great Recession, housing was down negative 8.9% on a national basis. So a 12% decline. I think I wrote that down right. Um, Quite the call for 2025.
Yeah, it is. We'll see how it goes. We'll
Yeah.
see. I just feel like everything that as much as we think a lot of the programs have run out and all
Mm.
this, there's still money out there sloshing around. And I think that the election, they're going to do everything they can to prop it
Right.
up. Like the little guys will be spinning in the wheels. But I think that after the election's done, it's going to be like, yeah, okay. And then the fighting's really going to begin about,
Yeah.
debt spending, all that stuff. So it's going to, I mean, hopefully we get there. I know some people are very cautious about this 24 election, but
Right.
I think we'll get there.
So it's because you and I both lived. You were far more in it than me, but we were both active during '06 to 12, which were painful, right? That had to be hard, a
Mhm.
hard 6 years. Saw lots of people
Yeah.
suffer lots of pain. It still hits me really hard. A 12% decline in 25 when the worst year was 8, 9. Now, maybe that's because it's collapsed in a shorter duration because the Great
Mhm.
Recession really was 6 years, kind of maybe 7 years top to bottom. Maybe what you're saying is 20 we're gonna do that in less time frame. Is that kind of
Correct. Because we
ah,
got there in such a faster time
got
frame.
it.
I think we'll
Okay.
correct it faster as well. And so, yeah,
All right, I get that logic.
yeah.
I like that.
But,
I like that.
who knows?
No, it's so far away. So many things
Yep.
can change, black swans left and right.
Yep.
All of those things. But
Yeah.
I love our conversations. I love the fact that you bring a different slant and experience to the channel. Melody, right? Lots of people need to be following you. Where should we send them?
Sure. So you can follow me on X Twitter is what I call it. But it's
X Twitter.
X Twitter. It's M3_Melody, MELODY, at Substack, M3 Melody Substack, on LinkedIn, Melody Wright, and then also M3 Melody YouTube, which is, I don't know why, but it's gaining a lot of
That's
um,
awesome.
some steam. Yeah. So
Yeah,
yeah.
go give her a follow on YouTube. Again, folks, you need to understand what's going on behind the scenes. Melody Wright has experience, knowledge on and skill that I do not have. She has access to data I do not have. She is someone that I listen to because she makes me better. So, Melody, thank you for being here.
Thank you. Thanks for having me. And you make me better as well. So thanks.
Awesome. Thank you.